Anyway, Avinash Gorakhsakar is with us, head of research at Malaysia's Capital. We'll ask him about the fundamentals of the market, and then Ruchit, technical chartist at Angel Broking. Ruchit, thanks very much for joining us. I wanted to start with your thoughts on Nifty, because see, you can look at a chart if underlying conditions are the same. But with yesterday, we don't know whether the underlying conditions are the same, or they could be reasonably altered or extremely altered or not altered at all. What would you do in that scenario?
Good morning, Ashu. Ashu, probably if we just first look at the weekly or the positional charts, then we had the formation of a shooting star pattern, which is a reversal pattern near the highs of 8,900, 9,000. So this is after a formation of that reversal pattern, what we are seeing is a corrective move of this entire up move, which we have seen in last 5 to 6 months. On daily charts, we have a first formation of a lower top, and yesterday's down move also formed a lower bottom pattern. So the short term view, although the longer term trend for the market still remains positive, but in the short term, I think this trend would be on the corrective side, and further lower levels would be seen in the markets. Now, any pullback, it comes what we are seeing in today's session from the lower levels, higher around 86.40 to 86.90 would now become a resistance zone, which was the earlier support. So as we say that, support once broken becomes resistance. So I think one should go with that theory as of now. Let this pullback come up to 86.70, 86.80, which is the higher end of this resistance range. One should again create short positions, and we are expecting on the lower side 8500, 8510 for the markets in probably next 1 week of time frame.
Right. Ruchit, also we've seen a phenomenon that every time a market cracks after a very big run-up, the general tendency of individual traders is to buy the next day because they think things are cheap, if I may call it. But Ruchit, we know that sometimes when events happen, they spread over a number of days, and that initial euphoria starts to die out. Just your thought on that, Ruchit, because it could be just that individual traders saying, oh, I couldn't get into the stock at this price, so great, now it's a buy on dip and I'm just going to buy. But buy on dip works fine if other conditions have remained the same. It doesn't work if there is a major event risk in the market.
Yes, exactly, Ashu. That's a very good question. If we see, then up to last week or even a couple of weeks earlier, the view for most of the traders was that in case even a dip comes, then one should use that as a buying opportunity. But now the thing is that where to buy. After formation of the low top, low bottom, we would always find support levels at every 50 or 100 points gap, because the market has risen in that fashion. So inspired, rather than looking at what is the next support level, once the initial support is reached, then you would see another 100 points lower the next support coming in. So one should not see where the support is coming. Now, since everyone now knows that the short-term trend is down or we are in a corrective mode, let the markets or the stocks itself show reversal signs from one of the support zones, then only one should consider buying. Now, the problem is that retail traders, which we say they want to buy at the bottom, they seem that since the market is already corrected, if they buy at current levels, the markets may bottom out and again resume the uptrend. Let the market, let the lower 4-5% of the bottom get mixed. Then also, if you enter and again after resuming of the uptrend, then it would be a good entry even if you leave the bottom 4 to 5%. So rather than looking at the supports at the lower levels and trying to take the bottom of the market, let the index itself show some sort of reversal signs or show some sort of stability. Then only I think one should consider buying at lower levels. As of now, as I said, there's a clear lower top, low bottom formation on the daily charts, and this probably last 6 months of up move which is there, that is going to get retraced for sure. So I think one should not do any kind of bottom fishing over here. Wait for further lower levels. Let the index itself show some sort of consolidation again at lower levels. Then one should consider, yes, which are the good stocks to buy, and then only one should look for buying opportunities.
Right, and so this is a very interesting point Ruchit is making. See, buy on dips has to be looked at it in a context. That doesn't mean that if a nuclear bomb is exploding, there's still buy on dips. Charts remain the same if nothing else has changed psychologically. That's a very important point, and please do keep it in mind. Otherwise, you'll be stuck with the wrong stocks. Avinash is also with us. Avinash, thanks very much for joining us. If the market had just fallen 400 points yesterday based on, let's say, European banks failing or problems with European banks, it would have been a very different phenomenon because we fell along with global markets. But when a market cracks because of an increase in any kind of uncertainty, and I'm just talking about pure risk, then we have to start revaluing it or re-looking at it. What are your thoughts, Avinash, given the events of yesterday, how the market has to be looked at from a risk perspective?
Yeah, good morning, Ashu. I think clearly, I think yesterday's event was definitely completely unexpected. And I think the way in which the announcement came in and the markets collapsed, our sense is that, at least for the next 4 to 5 days, until we get clearly visible concrete news flows that it's not going to emerge into a war-like situation. Because, after yesterday's all-party meeting, there was no clear indication as what could be the future strategy from what the government is speaking, and even Pakistan reacted very mildly, saying that they condemn all these actions. But the moot point is that at this point of time, any kind of news flow on the war kind of event is definitely a major risk. In fact, I would not be surprised if we go levels below 8,500 and probably look at 84 or 8450 odd level. Because clearly, I think whatever one says, I think the fundamentals remain intact. But the confidence and the sentiment has taken a big beating since yesterday. So yesterday, of course, was F&O expiry also, so that added fuel to the fire. But today, my sense is, people would be cautious. There's a weekend coming up. Nobody would like to have positions open as of today. So I would presume that over the next 1 week, I think markets would like to take a fact that beyond this, nothing happens, at least in the short term, both from India as well as Pakistan. And then only one could get a fair degree of sense whether this market would again start looking upwards. Till that time, I think, probably it's better to stay away and, wait for some concrete news.
Avinash, there are two ways to look at risk again. Let's say we were at the bottom of a bear market and Nifty had been at 6,000. And then an event like this would have caused the markets to drop 200 points. It may have been a very good buying opportunity because then you would have looked at the fact that the horse has been beaten so much that a little more flogging and is not going to change it. But if you look at it another way, in the market we are in, in any case, everybody was supremely concerned that maybe the valuations are stretched. Then the event or any uncertainty can cause much bigger magnified moves than it would if the index was at 6,000. Your thoughts on that?
No, exactly, Ashu. I think your point is extremely well said that, at these levels, the risk is definitely much higher because we are not at 6,000. We are closer at almost 9,000. And already, markets were looking pretty exhausted. The fatigue had already set in. So I think clearly, the risk for bigger upside was definitely absent. I think beyond 9,000, it was very difficult for earnings to actually push the markets go forward quite swiftly. So on the downside, already there was a kind of lever which existed because valuations had not become cheap. In fact, they were fair to quite expensive in certain kind of stocks. So yesterday's event has now made this, this has made the situation more vulnerable because in such a scenario, when valuations are not cheap, they're fairly expensive. The bashing for the markets could be quite significant. So I would presume that there could be some more correction down the line, and clearly in case of certain small cap companies, which have gone up by 40-50% in a very short time, these would be the first targets where possibly whoever is making some sort of money would obviously like to take it off the table and actually exit all his positions. So I would prefer to wait and watch. I mean, the mood is definitely cautious, and as you rightly said, not only the valuations but now the overall sentiment is clearly looking uncertain.
Right. So, Avinash, hold that thought. I'll come back to you on a couple of things as to how we should look at the markets. Ruchit, I have a couple of charts to look at. What concerns me only is that when there is a major or what the market considers a major event risk, then the charts somehow get suspended because we don't know. Charts work very well when we know the general psychology of the crowd, which is either it's uptrend or downtrend, which is what it was till day before yesterday. When the psychology of the crowd starts to get uncertain, then we don't know which trend will sustain and which won't. In that environment, Ruchit, what should we look at? Because financial services, tires, some chemical stocks, pharmaceutical stocks, ceramic stocks were running up. But I'm just wondering whether if it's safe to look at those charts till the time the market psychology stabilizes.
Yeah, actually, probably what happens in such times, when there are some news flows and the markets go either sharply up or down due to the news flows. Usually, the stocks which had already given a very sharp up move in the last few trading sessions, or you may take last couple of months, they tend to correct, because you can see that there are many long positions in that, and unwinding of the long positions, leads to the corrective move in those stocks. Now, one should clearly look at those stocks which have not performed, which are good on a long-term charts, and have not performed significantly higher, or have not moved significantly higher in last couple of months. Now, those stocks would not be prone to further downside from current levels. Now, if you just take example from current levels, from a positional perspective, we are like in Lupin. If we observe Lupin since last 1 year itself, the stock is in a corrective mode. The stock has formed a low top, low bottom post formation of higher levels around 1950. So now the downside from current levels in Lupin remains very much limited, even if you take Sun Pharma. So I think pharmaceuticals, specifically large cap pharma sector, which has not performed significantly in last couple of months, or in last 6 months, they would not be prone to further selling or profit booking now in the long positions. I think somehow one should not get carried away in the stocks which have rallied significantly. Let some sort of good amount of correction come in the stocks, then only look to again enter into the stocks. In case if anyone is looking to buy at current levels, large cap pharma stocks could be one of the sector wherein the downside seems to be very limited. And going ahead, this sector may again start to perform on the higher side when the next leg of up move comes in the market. So on the sectoral front, one can look at large cap pharma stocks, stock specific Lupin and Sun Pharma. These are the two stocks which we are recommending to buy from levels, keeping a mind frame of at least three to 4 months perspective.
Right. One of the things, Avinash, we also, from an investment perspective, we have to remember that whenever there is a major event risk in the market, or the market may move because of the budget or something else, usually, government insurance companies tend to intervene to kind of see that the market is where it is. But those interventions can only be worth something if the general mood of the market is stable. Otherwise, the government is just subsidizing buying stocks being sold by others. In this kind of environment, Avinash, I want to look at it this way. How do you see foreign investors looking at it? Because unlike us, they have the choice of being in many, many markets at the moment. Maybe they don't sell, but is it possible that they don't buy either till the time they can see stuff, getting back to normal?
Exactly, Ashu. I think, your point is right. Liquidity both from the local institution as well as the foreign institutional investors is definitely bound to take a short-term hit. And clearly, if you speak about the local institutions, yesterday they were net buyers to the tune of almost 1,600 odd crores. But, this kind of buying cannot be sustained for long if the overall event risk is yet continuing to be there. And, obviously the war-like situation is something which nobody has a handle on. And these kind of buying, cannot continue for a sustainable period of time. So obviously, they have also got to report a NAV and they have to report performance. So they can't go on buying relentlessly. Talking about the FIs, I would be not be surprised if for a couple of weeks, they would also put, their money bags on the hold for some time, because clearly, if they see an event risk like a war coming up and, whatever counter strategy Pakistan comes up with, I think that will be closely watched. It's not going to happen that yesterday, there was small firing from the Indian aircraft. Now, probably today everything is fine. So I think probably for the next 8 to 10 days, unless things cool off, I think liquidity flows both from the FIs and the local institutions is going to be on the hold. I wouldn't be surprised if the markets may see a complete lackluster, kind of volume, because clearly, the markets are now waiting for basically either this event risk to completely subside, or maybe some further developments to, come out either from the Indian side or from the Pakistan government side in the coming 1 week.
Right. So, Ruchit, I have a couple of stocks. I just wanted to see if you have any thoughts on the direction of these stocks. One is TVS Sri Chakra. That chart has been one of the cleanest charts that I've seen in terms of the fact that it doesn't even seem to have a day interruption, but maybe because the stock is high priced. Also, maybe there aren't too many individual investors in stocks like this. I don't know. Another one was Vishnu Chemicals, Murudeshwar Ceramics, and Nath Biogenes. Ruchit, if you've looked at any of these four or all of them.
Usually these are very low volume counters among the sector and among the stocks. What we have been looking since last few days, one of them is TVS Sri Chakra. Definitely, again, not that favorite, was not that favorite due to the lower volumes, but the trending move which it has taken out since last 2 months, that is quite phenomenal. The stock, after forming a higher top, higher bottom, if you observe the positional charts in the stock after forming a higher top, higher bottom, and rallying since up to August 2015. Then it went into a consolidation phase. It consolidated for about 1.5 years, and again it has resumed its uptrend. So on the higher side, it's very difficult to come out with a target for the stock since it's at all-time high and quite significantly higher than what the earlier high was. So I won't be able to give a definite target, but definitely the signs are quite positive in this stock because even at current levels, after rallying from about 2,800 or 2,600 to about 4,200 in just a month of time frame, the volumes are coming in even at current levels. There are quite higher volumes in last 3-4 trading sessions, which indicates that even at current levels, there are a good amount of buyers who are looking to buy this stock. The TVS Sri Chakra is one of the picks wherein I think a good amount of upside could be seen from current levels also. So if anyone is looking to buy fresh, definitely the risk reward won't be that favorable. But in case if you are high risk trader, then you can look to enter even at current levels in TVS Sri Chakra.
Right. Let's also look at TVS Motors if we can. Do you have a one-year chart, Smita, on this one? We'll just take a look at where that is headed because the Sri Chakra, of course, had a pretty clean trend. Yeah, so this one's also got a very nice trend, but maybe it's not a day trade because it tends to kind of be pretty volatile on a day-to-day basis, but otherwise an uptrend. Ruchit, your quick thoughts on TVS Motors?
Yeah, definitely TVS Motors also has a very clean chart since it's been forming this higher tops and higher bottom. But somehow there is I think the stock would get some sort of profit booking around current levels. Because if you observe, then the stock always broken its previous highs of 338, but some sort of reciprocal retracements in the stock would come around 365 to 370 range, and the stock is very closely trading near that higher end of the range. Now, if you observe the volumes which are there in yesterday's trading session in cash market, then when the stock went down, some sort of higher volumes came in, which indicates that some sort of profit booking now could come if the stock comes to this resistance zone of 370 to 375. It's not a good entry point at current levels, but those who are holding long positions can look to book profits around 370. Wait for a dip again to enter into the stock.
Right. Avinash, in all this melee, we all forgot one big thing which I thought was very major for IT stocks. If Deutsche Bank and Commerzbank are all down 60-70% in their market cap, and Avinash, I'm only telling you about German banks, but Spanish banks, Greek banks, Portuguese banks, Irish banks, all of them are down almost 50 to 60%. I'm just wondering how come these IT companies whose main business seems to be BFSI or whatever they call it, financial services, haven't batted an eyelid. How is it possible that the guys who give them the money themselves are sinking, but the guys who provide technology services are okay, all gung-ho?
I think, Ashu, your point is very valid. And I think, probably markets were taking a sigh of relief that the German government gave some assurance that, Deutsche Bank would be well supported. But, probably your reasoning is right that, if there are some further kind of cracks in some other global banks, then I think it's going to be a tough call for IT. As it is, we have seen that order book kind of visibility and recovery in the last 1 or 2 quarters has been pretty weak. In fact, there have been some companies who have given very strong earning kind of warnings. And this is going to be felt not only by the smaller IT names, but even the larger IT names like a TCS, a Wipro, Infosys. So I would be a little cautious. And as I've been really mentioning that, the markets have taken some sort of comfort that IT and pharma have now become clear defensives, after yesterday's development. But the overall structure for IT companies still remains weak. And I think post the September quarter, I think if there are some further negative surprises, post the Brexit developments or maybe, something like a Deutsche Bank, further accelerates into some further crisis for some further banks, then I think probably you could see some cracking in the larger cap names, especially a TCS or maybe, something like a HCL Tech or a Wipro, where my sense is earnings growth is going to be pretty weak. And without strong earnings growth, the kind of valuation these companies command, probably there is a kind of potential that we could see a downside even in these well-built, established names, something like TCS, which still continues to trade at a premium to both HCL Tech as well as Infosys. So preferably, it's better to be a little cautious here. I mean, and not be so gung-ho considering the kind of new developments which have happened since yesterday.
In fact, one of the interesting points that Avinash has brought up, the guys who may actually take a hit this time are the bigger guys. Because you see, a Deutsche Bank and Barclays Bank doesn't go to a small IT company. They go to the big ones. I don't have a breakup. But look, if these banks are in such a situation that they themselves are taking a begging bowl and going to their central banks, I mean, just think about our personal situation. If I don't have money to pay my home loan bank, I'm not going to be hiring expensive cooks. So I don't know how these stocks are holding up, but really, I mean, it's really strange that nobody mentions that half of European banks are close to closing down and nothing is happening to these IT companies. I don't know. Anyway, so let's put some of these charts. Let's put up TCS. Can we put up a 1-year chart? Can we put up Infosys 1-year chart, Wipro 1-year chart, and HCL Technologies 1-year chart? Let's look at what is going on in the charts itself first of all. So just take a look at what this chart looks like. Let's remove this one. Okay, let's get the other one. Ruchit, just purely on technicals, to me, Infosys looks exceedingly weak. I don't have a chart longer than 1 year, but Infosys, I can't even see which next support it's trying to take. Not that TCS or HCL Tech looked any better. Do you have Wipro? I didn't see Wipro for some reason, so let's just see if we can bring Wipro up. Even Wipro, Ruchit, very, very weak, but your thoughts?
Yes, Ashu, definitely last 3-4 months, this entire sector has underperformed, maybe for the reasons which you have earlier mentioned. And that's why we have seen that in spite of markets or the other financial stocks doing well in last 2-3 months, this sector as an entire has underperformed and has in fact shown corrective moves. But then this correction could still continue and we may see another leg of down move. There are no signs of reversal on the weekly or the monthly charts, on the daily charts of all the heavyweights, which includes Infosys, whether it's TCS or Wipro. So, and even Tech Mahindra seems to be on the negative side itself. And if you observe these 4-5 companies, then I think about 90% of the weightage in the Nifty IT index come from these 5 stocks, which is Infosys, TCS, HCL Tech, Wipro, and Tech Mahindra. Now, considering that none of the stocks are still showing signs of reversal, we may see some sort of underperformance could continue, or some sort of consolidation phase could continue in this stock. Infosys, if we talk about stock specific, then around 1,050, we have seen that there is some sort of resistance, 1,050, 1,060, and the support is around 1,000 levels. So this is indicating this entire sector as a whole for next few weeks or for next few months would either show a sideways corrective move, which would lead to a time correction, or a price correction with another leg of correction on the lower side in the last step stop.
All right, Ruchit, thanks very much for updating us with the technicals. I hope you enjoyed a much more deeper view of rather than just looking at charts, because that's required when we have events. And these are the greatest times to actually learn why one strategy works in one kind of market but may not work in another kind of market. Avinash, always a pleasure to speak to you. Thank you for updating us on the fundamentals on this edition of Market Movers. From Upasana, our producer, Smita and her team that put all the great graphics together, and from everyone that makes Market Movers possible, thank you for making us a part of your lives. Corporate Eye will be next, and Dipanshu and Hero will be joining.